Today, Monday the 17th of August, 2026, US dollar to Japanese yen is hanging around 159.00 after another failed push higher. That sounds calm, but the technical picture is warning. The pair is stalling just below the 50% Fibonacci retracement of its recent recovery, a level that has capped the upside near 159.50. In plain terms, that line marks a classic battle zone between buyers and sellers, and right now sellers are winning. Earlier today the pair dipped below 159.00, then stabilized near 159.45, which has already fed speculation about possible intervention. The early message this week is clear: upside momentum has faded, and the pair looks more fragile than it did last week. The main change has come from the US dollar. Friday's soft US retail sales miss reinforced the view that the Federal Reserve has little reason to keep raising rates, and that has kept the broader dollar index below 100. Normally, that should drag US dollar to Japanese yen lower, but the pair is not falling hard yet. The reason is the Japanese side of the equation. Traders have already priced in roughly 90 basis points of Bank of Japan rate increases by the end of 2027, which is a fairly hawkish outlook. That means the yen needs a fresh hawkish surprise to gain stronger momentum. The easy part of the dollar weakness story is already reflected in the price, which is why US dollar to Japanese yen is grinding sideways rather than breaking down quickly. For traders, the 50% Fibonacci level near 159.50 is acting as a lid. Every rally towards it loses steam, and the latest bull attempts have been cautious below that zone. The significance is not just technical. When a pair repeatedly fails at a major retracement level on soft US data, it tells you dollar buyers lack conviction. It also means stop-loss orders are likely building below the round number at 158.00, creating a coiled setup. Either the pair breaks 158.00 and accelerates lower, or it needs a strong US catalyst to reclaim 159.50. Right now the dollar has no such catalyst, so the path of least resistance is lower. Looking ahead today and through this week, the key levels are clear. A daily close below 158.00 would open the next downside targets at 156.50 and then 155.00, according to the weekly technical outlook. That is not a random forecast. It aligns with the break of the 50% Fibo and the absence of US dollar support. The risk to that view is a sustained move back above 159.50, which would invalidate the bearish setup and shift focus back towards 160.00. For now, fading rallies near 159.50 appears to be the more logical approach than chasing strength. Repeated rejections at that level will likely invite fresh selling. The bottom line for today is that US dollar to Japanese yen is not in freefall, but it is sitting at a fragile technical level. When upside momentum fades at the 50% Fibonacci retracement and the US data backdrop is soft, the smarter risk is usually a downside break rather than a clean rally. The trigger to watch is a daily close below 158.00. If that happens, the move towards 156.50 and then 155.00 could come quickly. Until then, patience matters. Let price confirm the break, and keep 159.50 as your line in the sand.